Yeah, it's a very good question. The price to earnings ratio, or often described as the PE of a stock, is one valuation method that's used to value a company on the stock exchange. So, very quick video just to explain exactly what the PE ratio, the price to earnings ratio, means. And in essence, if a company is earning $1 in earnings, and it's trading at a PE of 15, it means that people are prepared to pay 15 times that $1 for that stock. So in this case, the share would be worth $15 per share. So, and this is where the market uses the PE, but you've got to be very careful when using the price to earnings ratio as a measure of what a company or a business is worth. And over the years during the GFC, we saw PEs get down to 8s and 9s. So the market was very pessimistic, and people's mood and appetite to buy shares when everything was down and the news was terrible, it really pushed down the valuations. So obviously in hindsight you say, well, that was a great buying opportunity. PE ratios now are obviously close to 15, 16, 17, which is more around the average. Now, it can be a very crude measure of valuing a company, and we see a lot of companies, we've watched over many years, that can have a PE of 30 or 40 or even higher. Now, so people are paying 30 times the dollar's worth of earnings, or whatever that dollar is. Now, the big question mark there is, and what the market doesn't know, is what the future earnings might be. So a smaller, faster growing company's earnings may grow considerably quicker than what the market actually thinks. So if we've got a PE ratio of 30, when we're looking years down the track, that might be very wrong, and the earnings might be a lot higher than what the market thought. So instead of $1 per earnings, it's actually $2 per earnings. So at some stage, if you were paying 30 times earnings of $1, but a year later they came out and announced that earnings per share have gone up to $2, well, that back then when you were paying 30 times was essentially just 15 again. So it's a crude measure, but it's one that's used a lot, and whenever you're looking up reports or analysts' research, I'll talk about the price to earnings ratio all the time. So it is essentially a mechanism, the earnings and how many times people are prepared to pay for that earnings. And 15, 16, 17 is around the average, but for smaller companies it's very crude, and it's very hard to to actually work out what their earnings will be in the future.